recently we talked about Philip Morris International, and today we're going to talk and analyze Altria, which is basically an US version of Philip Morris. But actually it is much more than that, because Altria is a company that owns other companies like Philip Morris USA, US Smokeless Tobacco, John Middleton, Helix, Philip Morris Capital Corporation, and then some service companies and strategic investments. The way Altria is constructed makes it a company that is really covering a lot of ground, because on one hand they have cigarettes, then they have smokeless tobacco, they have pipe tobacco and cigars, and then they have other companies and investments that go into different areas. For example, AB International Beverages, that's one of the biggest breweries in the world. Then there's Juul and e-cigarettes, and Kronos, which is a leading company in cannabis. So as you can see, Altria is covering a lot of ground, and it makes it a company that is prepared for different situations in the market. So recently, Altria's stock has fallen dramatically. And the main reason for that is a problem with Juul. Well, in the United States, the officials said that Juul cannot be selling their products in the US because they are too harmful. But just few days after that was announced, the whole ban on Juul was lifted, or rather suspended, because they said they need more time to actually investigate. And we also have to remember that this ban is not permanent. If Juul makes some changes to their products, they can be back on the shelves in the US. So let's see if at the current price, Altria is a buy or not. So first of all, investors. Are there any insider buys? That's a negative. And what about super investors? So yes, there are some super investors, but not a lot of them invested in Altria. So there's nothing really that interesting considering investors. So let's see the fundamentals of Altria. What about return on invested capital? That's a check, and the return is really nice. It's 24.9%, so really nice return on that. What about free cash flow growth? That's an X, because they have a growth of 9%, which is decent, but what we are looking for is a free cash flow growth of 10 or more. So they're close. It's not a massive X, it's not a massive red flag, but it doesn't meet the criteria that I would like to have when I look at the company. Okay, what about share buybacks? That's a check. In the last 10 years, they bought 10.6% of their shares back. So that's really nice. The dividend yield, it's a check. And the dividend yield is 8.7%. Now, this is an outstanding dividend yield. One reason for that is the current price drop for Altria. And of course, if you see such a high dividend yield, you have to ask yourself, is this sustainable? Does the company have enough cash to actually pay those kind of dividends in the future? And if we look at the free cash flow from 2021 and the amount of money they paid in dividends the same year, they actually paid 87% of their free cash flow into dividends. So that's really a lot, but it is sustainable. And we also have to remember that Altria is raising their dividends every year for the last decades. Dividend yield right now is probably the main reason you could consider buying Altria. Okay, what about the debt of this company? So that's an X, because it would take Altria over 3 years to pay their debt with their current free cash flow. So that's a lot of debt, and we have to take this into consideration when we think about buying this stock. Okay, so let's look at the PE ratio. So the current PE is 25.16, and let's compare the current PE to the 5-year average PE of Altria. And that's an X because the 5-year average PE is 21.85. So the current PE, even with the recent drop of the price, is still above a 5-year average. So it seems that this company is still expensive. But let's see the PEGI ratio. The revenue growth is 2.4% and the dividend yield, like we said, is 8.7. So if we take the current PE and we divide it by the revenue growth and the dividend yield, well, that's an X because we end up with a PEGI ratio of 2.26. And what we are looking for is a PEGI ratio below 1. Okay, so let's do a valuation of this company. We will estimate the growth rate in a low scenario, in a medium scenario, and in a high one. So, okay, if the company doesn't do that well, the low scenario, we could make it 3%, and for another 5 years, 2%. The medium one, let's make it 5%, and after that, 4%. We have to remember that the tobacco market is shrinking in the US. Okay, and the high scenario, 7% in the next 5 years, and then 5% after that. Let's see what is the valuation. So the intrinsic value of this company is somewhere between $44 per share to $62 per share. But we always have to use a margin of safety. I use 30%. So if we include the margin of safety, the price we should be looking for is somewhere between $31 to $43. And the current price is 41.5. So, as you can see, the intrinsic value, it's all green, but when we add the margin of safety, only the high scenario is a buy. The other ones, not so much. In the low scenario, we're still missing about 25% to get to the price with the margin of safety. So is it a buy? Well, that's a tough call because on one side, it is an expensive stock, especially if you keep to the conservative estimates that we use for low and medium scenario. And that's the way you should approach it. You should be conservative because it makes your chances of getting it right much bigger. On the other hand, you do get over 8% dividend yield. So it depends what you are really looking for in an investment. Is the dividend the main thing you're looking for, or is it the growth of the company or the stability of the company? So do your own due diligence and decide which way of investing is really closer to you, which really applies and resonates with your character. Because as we know, investing is mainly about character, about mental strength and keeping to our principles. Okay, so I hope this analysis was helpful, and if so, then please like it and subscribe if you haven't already, and see you in the next one. Bye bye.